Question 1. Which of the following best describes the primary function of the National Futures Association, NFA? A. To regulate the securities markets and protect investors. B. To act as the sole regulatory body for commodity futures and options exchanges. C. To serve as the self-regulatory organization, SRO, for the U.S. futures industry, including CTAs and CPOs. D. To provide insurance for customer accounts in the event of broker-dealer insolvency. Answer: C. To serve as the self-regulatory organization, SRO, for the U.S. futures industry, including CTAs and CPOs. The National Futures Association, NFA, is the primary self-regulatory organization, SRO, for the U.S. futures industry, operating under the oversight of the Commodity Futures Trading Commission, CFTC. Its main role is to develop and enforce ethical standards and rules of conduct for its members, which include commodity trading advisors, CTAs, and commodity pool operators, CPOs, to protect the integrity of the markets and safeguard investors. The NFA handles member registration, ongoing compliance, and disciplinary actions. Remember, the NFA is specifically focused on the futures industry, distinct from securities SROs like FINRA. Question 2. A commodity pool operator, CPO, must generally deliver a disclosure document to a prospective participant in a commodity pool how many days before the participant's funds are accepted? A. At least 5 calendar days. B. At least 10 business days. C. At least 21 calendar days. D. At least 15 business days. Answer: C. At least 21 calendar days. A commodity pool operator, CPO, is generally required to deliver a disclosure document to a prospective participant at least 21 calendar days before accepting their funds for investment in a commodity pool. This mandatory waiting period ensures that potential investors have sufficient time to carefully review all material information about the pool, its risks, fees, and the CPO's background before making a commitment. This rule highlights the importance of full disclosure and informed decision-making in the managed futures space. Make sure to remember this specific delivery timeframe, as it's a critical regulatory requirement for CPOs. Question 3. Under NFA rules, which of the following is considered an unacceptable representation regarding a commodity trading advisor's, CTA, past performance? A. Presenting hypothetical performance data without a clear disclaimer. B. Showing actual past performance for the last 5 years. C. Including all material facts and disclosures with performance data. D. Using only the net performance results after all fees and expenses. Answer: A. Presenting hypothetical performance data without a clear disclaimer. NFA rules strictly prohibit the presentation of hypothetical performance data without a clear and prominent disclaimer stating that the results are hypothetical and do not represent actual trading. Such a disclaimer is essential because hypothetical results often have inherent limitations, like not accounting for the impact of liquidity or actual market conditions, which can be misleading to potential clients. Transparency in performance presentation is paramount to ensure investors are not misled by simulated returns. Always be wary of performance figures that aren't clearly labeled as actual or hypothetical. Question 4. An individual providing advice to clients regarding trading in futures contracts for compensation, but who does not manage client funds, would typically register as which of the following? A. A commodity pool operator, CPO. B. A futures commission merchant, FCM. C. A commodity trading advisor, CTA. D. An introducing broker, IB. Answer: C. A commodity trading advisor, CTA. An individual or firm that provides advice regarding trading in futures contracts, options on futures, or swaps for compensation is generally required to register as a commodity trading advisor, CTA. This role focuses on providing trading advice, regardless of whether they manage discretionary accounts or simply issue recommendations. In contrast, a commodity pool operator, CPO, manages collective investment vehicles, while futures commission merchants, FCMs, accept customer orders and funds, and introducing brokers, IBs, solicit orders but do not accept funds. Understanding the distinct roles of these entities is key to the Series 31 exam. Question 5. Which of the following best defines a commodity pool under NFA rules? A collective investment vehicle that trades solely in traditional securities like stocks and bonds. B. An enterprise where funds contributed by participants are combined for the purpose of trading commodity futures, options, or swaps. C. A fund that invests primarily in physical commodities for long-term hold. D. An arrangement where a single investor trades futures contracts through a CTA. Answer: B. An enterprise where funds contributed by participants are combined for the purpose of trading commodity futures, options, or swaps. A commodity pool is precisely defined as a collective investment vehicle where funds contributed by multiple participants are combined and invested in commodity futures, options on futures, or swaps. The commodity pool operator, CPO, then manages these aggregated funds, trading them according to a stated strategy. This structure allows investors to gain exposure to the commodities markets without directly trading futures contracts themselves. Think of a commodity pool as similar to a mutual fund, but focus specifically on the volatile world of futures and options. Question 6. A commodity trading advisor, CTA, must disclose specific risk factors in its disclosure document. Which of the following is considered a mandatory disclosure? A guarantee of minimum returns for investors. B. A statement that past performance is indicative of future results. C. That the CTA's trading program may be speculative and involve substantial risk of loss. D. An assurance that the CTA has never experienced a losing trading period. Answer: C. That the CTA's trading program may be speculative and involve substantial risk of loss. CTAs are required to disclose that their trading programs are speculative and involve substantial risk of loss in their disclosure document. This is a critical risk factor that must be prominently stated to ensure investors understand the inherent volatility and potential for significant capital erosion when participating in managed futures. Unlike guarantees or assurances, the purpose of a disclosure document is to fully inform investors of the risks, not to downplay them. Always remember that disclosure is about transparency, especially regarding potential losses. Question 7. According to NFA rules, an associated person, AP, of a commodity trading advisor, CTA, is generally required to undergo what type of examination? A. FINRA Series 7. B. FINRA Series 31. C. FINRA Series 63. D. NFA Series 3. Answer: B. FINRA Series 31. An associated person, AP, of an NFA member commodity trading advisor, CTA, who solicits or accepts orders for managed futures accounts is generally required to pass the FINRA Series 31 examination. The Series 31 qualifies individuals to function as an AP of an NFA member firm, specifically focusing on the managed futures side. While other exams like the NFA Series 3, National Commodity Futures Examination, are for more broad futures industry registration, the Series 31 is tailored for those associated with CTAs and CPOs who already hold certain securities licenses like a Series 7 or 6. Question 8. An individual acts as an associated person, AP, for an NFA member firm. If this individual changes their sponsoring NFA member firm, what is generally required regarding their NFA registration? A. The AP must retake the Series 31 exam. B. The AP's registration automatically transfers to the new firm. C. The new firm must submit a new Form 8R to the NFA, but the AP does not need to retake the exam. D. The AP must wait 90 days before associating with a new firm. Answer: C. The new firm must submit a new Form 8R to the NFA, but the AP does not need to retake the exam. When an associated person, AP, changes their sponsoring NFA member firm, the new firm is generally required to submit a new Form 8R, application for NFA associate membership, to the NFA on the AP's behalf. Assuming the AP's previous registration was active and there are no new disqualifying events, they do not need to retake the Series 31 or other required exams. This process ensures the NFA maintains an accurate record of who is associated with which member firm for regulatory oversight. This is a common practice for licensed individuals transitioning between firms. Question 9. Which NFA requirement is designed to prevent the commingling of customer funds with a futures commission merchants, FCM, own funds? A. Segregation requirements. B. Disclosure document delivery. C. Suitability rules. D. Anti-money laundering, AML, policies. Answer: A. Segregation requirements. Segregation requirements are a cornerstone of customer protection in the futures industry, mandating that futures commission merchants, FCMs, keep customer funds separate from their own proprietary funds. This ensures that in the event of an FCM's financial distress or bankruptcy, customer funds are protected from creditors' claims and are readily available for distribution to customers. This prevents misuse and ensures the integrity of customer assets. Think of segregation as a protective barrier around your investment, designed to keep it safe from the firm's operational risks. Question 10. A commodity pool operator, CPO, is reviewing advertising materials for a new commodity pool. Which of the following is considered a prohibited practice? A. Presenting net performance results, inclusive of all fees. B. Using language that guarantees future profits. C. Including a clear and prominent disclaimer about the risks involved. D. Showing the pool's historical performance for the past 3 years. Answer: B. Using language that guarantees future profits. NFA rules explicitly prohibit the use of language that guarantees future profits or minimizes the risks of trading futures and options. Such statements are inherently misleading and violate the NFA's fundamental ethical standards, which prioritize investor protection and truthful communication. Advertising and marketing materials must always be balanced, fair, and not contain any false, misleading, or deceptive statements. Remember, if it sounds too good to be true, it almost certainly is, especially in the volatile world of commodity trading. Question 11. An investor is considering participating in a commodity pool. Which of the following factors is most important for the commodity pool operator, CPO, to assess to ensure suitability? A. The investor's favorite color. B. The investor's risk tolerance and financial ability to bear the potential loss. C. The investor's social media presence. D. The investor's preference for physical commodities over futures. Answer: B. The investor's risk tolerance and financial ability to bear the potential loss. When assessing suitability for participation in a commodity pool, the most important factors for a CPO to consider are the investor's risk tolerance and their financial ability to withstand the potential for substantial loss. Commodity pools are speculative investments and are not suitable for all investors. A CPO must understand if the investor genuinely comprehends the risks and has the financial capacity to absorb potential losses without jeopardizing their financial security. Suitability ensures that investments align with an investor's financial situation and objectives. Question 12. What is the primary purpose of the Commodity Futures Trading Commission, CFTC? A. To serve as the primary SRO for the securities industry. B. To regulate U.S. commodity futures, options, and swaps markets to protect market users and the public. C. To provide insurance for customer accounts at banks. D. To manage the Federal Reserve System and set monetary policy. Answer: B. To regulate U.S. commodity futures, options, and swaps markets to protect market users and the public. The Commodity Futures Trading Commission, CFTC, is the independent federal agency that regulates the U.S. commodity futures, options, and swaps markets. Its primary mission is to protect market users and the public from fraud, manipulation, and abusive practices and to foster open, competitive, and financially sound markets. While the NFA acts as an SRO, the CFTC is the overarching government regulator for the derivatives markets, setting rules and enforcing compliance. Always distinguish between the CFTC as the federal regulator and the NFA as the industry's self-regulator. Question 13. Which of the following NFA requirements applies to all NFA members, including commodity trading advisors, CTAs, and commodity pool operators, CPOs, regarding their supervisory obligations? A. NFA members are only responsible for supervising registered employees. B. NFA members must diligently supervise the activities of their employees and agents relating to their futures activities. C. NFA members are exempt from supervision if they operate as a sole proprietorship. D. NFA members only need to supervise activities conducted on their main office premises. Answer: B. NFA members must diligently supervise the activities of their employees and agents relating to their futures activities. NFA rules require all NFA members, including CTAs and CPOs, to diligently supervise the activities of their employees and agents, specifically those relating to their futures activities. This broad supervisory obligation ensures that all individuals acting on behalf of the member firm comply with NFA and CFTC rules and that customer interactions are handled ethically and professionally. Effective supervision is crucial for maintaining market integrity and protecting investors from misconduct. This includes establishing written supervisory procedures and ensuring they are followed. Question 14. When a commodity trading advisor, CTA, presents performance data, what key principle must be followed regarding the inclusion of fees and expenses? A. Performance data may be presented gross of all fees and expenses, provided a separate fee schedule is given. B. Performance data must always be presented net of all fees and expenses, including advisory fees, commissions, and any other charges. C. Performance data only needs to reflect trading profits, excluding administrative costs. D. Fees and expenses may be optionally deducted, depending on the CTA's preference. Answer: B. Performance data must always be presented net of all fees and expenses, including advisory fees, commissions, and any other charges. NFA rules require that performance data presented by a commodity trading advisor, CTA, must always be presented net of all fees and expenses. This means that all charges, such as advisory fees, commissions, and any other trading or administrative costs, must be deducted before reporting performance results. This ensures that investors see the actual returns they would have received, providing a realistic and transparent view of the CTA's profitability. Remember, net performance means after everything is taken out. Question 15. A registered associated person, AP, receives an oral customer complaint alleging fraud. Under NFA rules, what is the AP's immediate obligation? A. To resolve the complaint directly with the customer without involving the firm. B. To document the complaint and promptly notify their supervisor or the firm's compliance department. C. To tell the customer that only written complaints are accepted. D. To disregard the complaint if it is not in writing. Answer: B. To document the complaint and promptly notify their supervisor or the firm's compliance department. When an associated person, AP, receives any customer complaint, whether oral or written, alleging fraud or any other serious misconduct, their immediate obligation is to document the complaint and promptly notify their supervisor or the firm's compliance department. NFA rules require firms to maintain records of all customer complaints and to investigate them appropriately. Ignoring or trying to resolve a complaint without proper internal channels can lead to severe regulatory violations. Always escalate customer concerns quickly and formally. Question 16. What is the primary purpose of the Statement of Additional Information, SAI, in the context of a commodity pool's disclosure document. A. To summarize the pool's key investment objectives. B. To provide supplementary information that may be material to a potential investor but is not required in the body of the main disclosure document. C. To list all the individual positions held by the commodity pool. D. To serve as a marketing brochure, rather than a regulatory document. Answer: B. To provide supplementary information that may be material to a potential investor but is not required in the body of the main disclosure document. The Statement of Additional Information, SAI, for a commodity pool serves as a supplemental document that provides more detailed, material information that is not required in the main body of the disclosure document. This could include extensive financial statements, detailed organizational structure, or specific conflicts of interest disclosures that might be too lengthy for the primary document but are still relevant for an investor's due diligence. It offers deeper insight for those who wish to conduct a more thorough review. Think of it as an appendix with crucial, additional details. Question 17. An NFA member firm is required to establish and maintain an anti-money laundering, AML, program. Which of the following is a core component of such a program? A. A requirement to report all customer transactions to the NFA daily. B. The designation of an AML compliance officer. C. An exemption for small firms from AML requirements. D. A policy of only accepting cash payments from clients. Answer: B. The designation of an AML compliance officer. A core component of an NFA member firm's anti-money laundering, AML, program is the designation of an AML compliance officer. This individual is responsible for overseeing the firm's AML policies and procedures, ensuring compliance with the Bank Secrecy Act, BSA, and related regulations. An effective AML program also includes internal controls, ongoing employee training, and independent testing. This framework is vital for detecting and preventing financial crimes, thereby protecting the financial system's integrity. Question 18. Under NFA rules, a commodity trading advisor, CTA, must perform due diligence on a prospective client to ensure: A. The client has a large social media following. B. The client's investment objectives and financial situation are compatible with the CTA's trading program. C. The client is willing to pay high upfront fees. D. The client agrees to never ask questions about the trading strategy. Answer: B. The client's investment objectives and financial situation are compatible with the CTA's trading program. A commodity trading advisor, CTA, must perform due diligence on prospective clients to ensure their investment objectives and financial situation are compatible with the CTA's trading program. This is a crucial aspect of suitability, meaning the CTA must verify that the speculative nature and potential risks of their trading strategy align with what the client can financially and emotionally tolerate. The CTA should determine if the client understands the risks and has the financial capacity to bear potential losses. This assessment protects both the client and the firm. Question 19. If a commodity trading advisor, CTA, uses actual, past performance data in its promotional material, which of the following statements about that data is true? A. It must always be extrapolated to show future guaranteed returns. B. It represents results from actual trading in customer accounts or proprietary accounts, calculated net of all fees and commissions. C. It can be presented before deducting any trading commissions or advisory fees. D. It only needs to include profitable trading periods to highlight success. Answer: B. It represents results from actual trading in customer accounts or proprietary accounts, calculated net of all fees and commissions. When a commodity trading advisor, CTA, presents actual, past performance data, it must genuinely reflect the results from actual trading activity in customer accounts or the CTA's own proprietary accounts. Crucially, this performance must be calculated and presented net of all fees and commissions, meaning all expenses are already deducted. This ensures that the reported figures are realistic and reflect what an investor would have truly experienced. Always remember that actual performance must be real, verifiable, and net of costs. Question 20. Which of the following NFA rules prohibits fraudulent conduct by members and their associated persons, APs? A. Rule 2-4, Just and Equitable Principles of Trade. B. Rule 2-29, Communications with the Public. C. Rule 2-9, Supervision. D. Rule 2-10, Recordkeeping. Answer: A. Rule 2-4, Just and Equitable Principles of Trade. NFA Rule 2-4, titled Just and Equitable Principles of Trade, broadly prohibits NFA members and their associated persons, APs, from engaging in any fraudulent, deceptive, or manipulative act or practice. This fundamental rule underpins the ethical conduct expected in the futures industry, ensuring that all interactions with customers and the market are fair, honest, and transparent. While other rules cover specific areas like communications or supervision, Rule 2-4 is the overarching principle against dishonest behavior. This rule is central to maintaining trust and integrity. Question 21. A commodity pool operator, CPO, intends to offer an interest in a new commodity pool. What essential document must the CPO generally prepare and provide to prospective participants? A. A bond prospectus. B. A stock offering circular. C. A disclosure document. D. A mutual fund summary prospectus. Answer: C. A disclosure document. When a commodity pool operator, CPO, intends to offer interests in a new commodity pool, they are generally required to prepare and provide a disclosure document to prospective participants. This comprehensive document, mandated by the CFTC and NFA, details all material information about the pool, including its trading strategy, risks, fees, performance history, if applicable, and background of the CPO and its principals. It's the primary tool for informed investor decision-making in the managed futures space. The disclosure document is the cornerstone of transparency for commodity pools. Question 22. Which of the following is considered a guaranteed account, and is generally prohibited under NFA rules for commodity trading advisors, CTAs, and futures commission merchants, FCMs? A. An account where the CTA guarantees to make specific trades. B. An account for which the CTA or FCM guarantees against loss or guarantees a profit. C. An account where the customer's initial deposit is fully insured by a government agency. D. An account managed by a CTA with a proven track record of profitable returns. Answer: B. An account for which the CTA or FCM guarantees against loss or guarantees a profit. NFA rules explicitly prohibit guaranteed accounts, meaning a commodity trading advisor, CTA, or futures commission merchant, FCM, cannot guarantee against loss or guarantee a profit in a customer's account. Such guarantees are inherently misleading in the speculative and volatile futures markets and are deemed unethical and fraudulent. Customers must understand that futures trading involves significant risk and the potential for substantial loss. This prohibition ensures that customers are fully aware of the inherent risks, without false assurances. Question 23. Under NFA rules, which of the following is a common conflict of interest that a commodity trading advisor, CTA, must disclose in its disclosure document? A. The CTA's proprietary trading for its own account. B. The CTA's favorite commodity to trade. C. The CTA's office address. D. The CTA's annual budget. Answer: A. The CTA's proprietary trading for its own account. A common conflict of interest that a commodity trading advisor, CTA, must disclose in its disclosure document is its proprietary trading, which involves the CTA trading for its own account. This presents a potential conflict because the CTA might prioritize its own trades over those of its clients, or it might have an informational advantage. Disclosing such activities ensures transparency and allows clients to be aware of potential competing interests. Full disclosure of conflicts is essential for maintaining investor trust and complying with regulatory requirements. Question 24. An associated person, AP, of an NFA member firm is communicating with a prospective client about futures trading. Which of the following statements would be considered misleading and a violation of NFA rules? A. Futures trading involves significant risk, and you could lose more than your initial investment. B. Our CTA's performance has been excellent, but past results are not necessarily indicative of future results. C. You can expect to double your money within a year with our proven trading system. D. We offer a diversified approach to managing futures exposure. Answer: C. You can expect to double your money within a year with our proven trading system. Statements that promise specific returns, such as, you can expect to double your money within a year, are considered misleading and violate NFA rules. Such promises create unrealistic expectations and minimize the substantial risks inherent in futures trading. NFA rules require all communications with the public to be fair, balanced, and not contain any false, misleading, or deceptive statements. Always be wary of any claims that guarantee specific returns, as they are prohibited and a red flag for potential fraud. Question 25. An NFA member firm must generally retain records related to its futures activities for a minimum of how many years? A. 1 year. B. 3 years. C. 5 years. D. 7 years. Answer: C. 5 years. NFA rules generally require NFA member firms to retain records related to their futures activities for a minimum of 5 years from the date of creation. This includes a wide range of documents such as customer agreements, trade confirmations, account statements, and communications. Maintaining these records is crucial for regulatory oversight, audit trails, and resolving potential disputes. Proper record-keeping ensures transparency and accountability within the futures industry. Remember this common retention period for compliance purposes.